Hello and welcome. This is KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every single day. Well, the summer months are upon us. They will be, of course, in a certain next few weeks, notwithstanding the heat wave that many regions in India are already facing. Well, we are taking up a company which addresses exactly that, Symphony. This company, as we all know, is one that focuses on coolers specifically. And of course, not only does it manufacture, but also trades and markets air coolers across India and certain other regions in the world as well. Well, it does have a presence in the domestic markets where it is, of course, the largest player here as far as air coolers are concerned, but also has a considerable presence in international markets. As far as its presence is concerned, it is considered to be one of the largest air cooler manufacturers, in fact, in the world. And it doesn't just look at residential, but also looks at commercial and industrial coolers too. So that gives the company that much of an optionality and an advantage as well. Well, notwithstanding that, there have been times of late where there's been a little bit of volatility with respect to earnings from the company. But if you disregard that, there certainly has been dominance as far as its presence in the coolers space is concerned. While there are a lot of other companies, there are a lot of other listed companies who also deal in coolers, it does seem like that at the moment that Symphony has taken it upon itself to focus only and essentially on the cooler segment. So that is something which stands out for Symphony. But, I'm going to shift focus to all that we're going to talk about with respect to Symphony. So, as usual, what we tend to do is that we talk to you about the company's fundamentals. So, we start by taking a look at the income statement. We take a look at the balance sheet and how things are panning out. Cash flows, of course, along with return ratios. And once we're done with the financial statements, we look beyond and take a look at the shareholding pattern, how the company's stock has done over the past many periods, not to forget the valuations as well as street coverage. So these are some of the aspects that we are going to take a look at. Of course, when it comes to valuations, we will also compare it to some of their closest peers in this case. But to take us through some of these aspects, I am also joined by my colleague Mahima Vachrajani, who's going to also help us elucidate further as to how things have panned out. So, Mahima, good morning and thank you for joining in. Let's start by looking at how things have in fact panned out when it comes to growth in the bottom line for Symphony.
Right. So, in terms of the four key metrics, that we always evaluate where income statement comes into picture, revenue as well as net profit, both have seen, high single digits or an early double digits growth. When we see the 3-year CAGR, revenue in terms of 9 months FY25 stood at around 1,088 crores. The 3-year CAGR for revenue has been around 8.7%. EBITDA CAGR has been 6.5%. This is a 3-year CAGR, of course. Margins, however, have improved for the company from 14.7% in FY24 to around 19.4% in 9 months FY25. And this is because there are certain margin accretive products which are now picking up in terms of sales. And they've also taken initiatives to optimize their costs, which is why margins are going up. But net profit overall has also had a 3-year CAGR of around 11%. So since the growth is in high single digits and low double digits, we're giving a thumbs down when it comes to the income statement. In terms of the subsidiary performance, 9 months performance, Mexico saw revenue growth of around 8% in INR terms. China revenue growth was around 2 times. But China, of course, is on the lower base as well. It's comparatively newer. Brazil revenue growth was at 61%, and Australia, however, is not performing well for them. The Mexico and the Australia subsidiaries are also going under transformation. And the focus in both of these areas is reduction of cost. And for Australia specifically, the management has said that they plan to reduce costs from around 15 million to around 7.5 million. In terms of product developments, recently in the past 9 months, they've launched 17 new model of air coolers, which are the high margin accretive coolers, and they've also entered into the water heater segment. So in terms of the where income statement is concerned, it's a thumbs down, but overall subsidiaries are doing well except for Australia, and new product launches definitely working in favor of the company.
Okay, so that's as far as your income statement is concerned, and again, I know that we've been talking about how things have potentially panned out for well, some of its subsidiaries. So, of course, as we've been talking about, Australia, Mexico, China, and Brazil have been showing some amount of contribution as far as growth is concerned. But we'll potentially take this up with the management as well in terms of what we can, in fact, expect going forward. But I'll talk about the balance sheet at the moment, and it does seem like it's in a reasonably good place as far as the balance sheet goes. Because, firstly, its net worth at the end of FY24 it stood at around 750 crores. And it doesn't have too much of a gross debt. So it does seem like it's in a comfortable place. In fact, its cash and bank stood at around 43 odd crores at the end of FY24. So it actually has negligible debt on its book, which always bodes well for the company. It's nearly the same when it comes to the first half of this financial year as well. Not much has changed there. And again, on a virtual basis, net debt free, which means that as far as its balance sheet is concerned, it's in a fairly good place, and which is why we'll give this one a thumbs up as well. In that case, on Mahima, let's also talk about its cash flows and cash flows from operations particularly.
Right. So, in terms of cash flow from operations, there has been, a trend where they have improved as compared to the first half of FY24. First half of FY25 has done much better. FY24, the numbers stood around 353 crores, which is now come up to around 494 crores. And net cash flow position for the company has turned into positive. In first half of FY24, it was a negative cash flow of around 28 odd crores, but that has now turned cash positive, and it stands at around 5 crores. So, since both the cash flow from operations as well as the net cash flows are improving, and the net cash flows have turned positive, we've given a thumbs up when it comes to the cash flow metrics.
Okay, so that's as far as cash flows go. I'll talk about return ratios. We want to talk about the dividend payout ratio as well, but we'll talk about that a little later on when we take up street credentials, because, it just adds up in that particular area. So I'll talk about return ratios right now. Firstly, when it comes to your return capital employed and return on equity, the ratios are sub 20%. This is a consumer durables company, so it's not unlike you can't have 20% return ratios, but at least as far as Symphony is concerned, for 2023 the ROC stood at around 18%, and that's actually come off further. That's also bearing in mind that it's been a challenging handful of quarters for Symphony as well. Return on equity, again, there's been a little bit of an improvement over the last 1 year. There's no doubt about that. But this particular one is also below the mark of 20%, which means that we're going to give this particular aspect of the return ratios a thumbs down. And while we have seen an improvement in ROEs, ROCEs has also come off. And this particular year is also going to be one which has already turned out to be a challenging one, given the way things have panned out over the last 9 months. It's going to be a wait and watch as to how things could pan out eventually for the final quarter of this financial year. And do remember that this final quarter of the financial year also has a little bit of a seasonality effect, which in fact plays in favor of the company. Hence, that we'll just wait for the last 15 days and the earnings to come through over this, and then perhaps we can take a better look at some of your return ratios as a metric as well. But for now, it's a thumbs down. Mahima, why don't you tell us about shareholding then in this case right now?
So, in terms of shareholding, the promoter hold is definitely strong in this particular country, and it hasn't changed, since years. I mean, if we compare March 22 position to December 2024 position, the promoter holding has probably increased from 73.2 to 73.4. So, promoter holdings, holding in the company is pretty strong, which is why we've given a thumbs up. In fact, the FI position valuation has also improved from 4.5% in March 22 to around 6.8 in December 24 as well. And we are seeing that FIs have steadily increased their stake in this particular counter. DIs, however, have been kind of reducing their stake. DIs were holding around 10% in March 2022, which has come down to around 9% in September 2024, and further come off to around 8.5% in December 2024. So in this case, FIs are kind of steadily increasing their stake, but DIs are kind of steadily decreasing their stake. And in terms of public shareholding has pretty much remained within the same range. It was around 12% in March 2022, which has gone to around 11% in September 2024, and as of December 2024, it stands at around 11.3%. But overall, strong promoter holding, FIs also steadily buying, and that's why we have given a thumbs up where the shareholding pattern is concerned.
Just a quick note on DIIs as well. At the moment, for all the companies listed with an ownership of over 1%, we have HDFC Mutual Fund only. But over the past many quarters, there have been plenty of AMCs who have held Symphony at some point of time or the other. Of course, we must remember that it's been a very volatile bunch of months, not just for Symphony, but the entire mid-cap and small-cap space. And I reckon that Symphony will be, one of those companies where the shareholding of some of these AMCs will have gone sub 1%, which is why they don't show up in terms of ownership right now. But it doesn't mean that a lot of these, AMCs don't have ownership in the company. But the other, of course, positive here is that we just have about 11% out there in terms of the hands of retail and HNIs, which means that there's a little bit of scarcity as well, because a majority, that means nearly 89%, is held by promoters and institutions. And the assumption here, of course, is that a lot of these institutions hold on for the long term, which also gives the company a little bit of a scarcity premium, so to speak. So that's as far as your shareholding is concerned. But I come to the aspect of street credentials. So when it comes to returns for this particular company, we do know that it's been a challenging time for the entire mid-cap and the small-cap space. And I reckon that Symphony has also been a victim of this particular correction, so to speak. So we have seen a slide of around 31% in the last 6 months, and if in fact year-to-date basis also we've seen a decline of around 16%. But Symphony has also underperformed the respective mid-cap and the small-cap indices as well. And besides that, the only thing that could potentially work in favor of Symphony is a fairly decent dividend payout ratio. Now, remember that this is meant to be a growth company because of the size at which it currently operates, but it does give out, it does have a fairly large dividend payout ratio, which may work in favor of the company. As you can see, 61% in FY24. But as far as your returns are concerned, if you're looking for capital appreciation, and usually investors look for capital appreciation for a size at which Symphony operates, that's just not come through. And while we can understand that there could be a little bit of a decline on account of your overall weakness in the markets, well, it's going to be a wait and watch whether or not if the recovery comes in at what point in time. It's not like it's been a growth stock because, as Mahima has already mentioned, we're not looking at anything in terms of your net profits on your top line growth over the last 3 years. So it's been a challenging time, and so that's also the reason why we are looking at that. While, below average price action with respect to the respective mid-cap and the small-cap indices. But that's as far as your returns go in terms of price action. Has that had any impact on valuations? Well, Mahima, why don't you tell us that?
Right. So not really, because valuations, on a standalone basis still look expensive, because 12 months trailing PE, it stands at around 51 times. Going ahead also, as per Bloomberg estimates, 2025 and 2026. 2025 it goes to around 32 times. 2026 it goes to around 28 times. So still not looking cheap, but as compared to peers, something like a Whirlpool or a Blue Star or a Voltas, although Blue Star and and Voltas are into ACs, but still, since they are, they produce, products that are useful in summers, that is ACs, they are, if they're not like-to-like peers, they're still peers, which is why, as compared to peers like Whirlpool, Blue Star and Voltas, the valuations are a tad bit better for Symphony, because Symphony is 12-month trading at 51 times, but Whirlpool is at 54, Blue Star at 97, and the most expensive one is Voltas, which is at 179 times. So since on a standalone basis it does not look very cheap, but as compared to peers, it is a tad bit better. We've given a neutral rating where valuations come into picture.
So there's no taking away of the fact that the entire sector is looking at a little bit of a slowdown. But that said, we still have at least the street giving a considerably higher growth rate for, well, some of its peers like Blue Star. On the other hand, we also have a lot of volatility in earnings for a company like a Voltas or a Whirlpool. I want to make this mention again, something that Mahima has spoken about. It is not a like-to-like comparison, because Symphony in this case focuses essentially on coolers, whereas all the other peers do have a lot of the other segments which they cater to as well, which is why it may not be a completely fair picture in terms of comparing Symphony with perhaps a Whirlpool, a Blue Star or a Voltas, but it's just that in the listed universe, these are some of its relatively closer peers. And as Mahima once again mentioned, that it does currently trade at a discount to, well, its overall valuations when it comes to its peers. But I'll come to analyst recommendations then. So firstly, on the street, there are 8 analysts who cover the stock. And of these 8 analysts, we have 4 analysts who have a buy on this particular company. 2 analysts have a hold and 2 have a sell. So when it comes to positive versus potentially not going anywhere, it's a 1:1. And which is why we're going to give this a neutral rating as well. Sure enough, if you do take the consensus, well, target price for Symphony, that entails a 34% return potential from current market levels. So there's a 34-35% upside from current market levels. And that's something that you can take in, I can consider, which is why we're going to give it a neutral rating as well. So that actually brings us to your overall rating. So let's bring that aspect, into consideration as well. Now, notwithstanding the volatility that the entire sector has seen in terms of, the earnings, there you have it. These are some of the ratings that we're giving. So very strong balance sheet, very strong cash flows, income statement. We're seeing growth, but maybe not to the extent that the street may expect. And moving on to the next set of, parameters, shareholding, of course, looks very strong. Valuations and street coverage, well, it's going to be a neutral rating. So the question really is that how much does it score? Well, it gets a 4 out of 8 at the moment. But let's move on and talk about certain other aspects. We do have the management here with us. Nrupesh Shah is waiting by to talk to us. But before that, I want to just quickly explore a handful of other ideas before we actually take this forward with him. So, Mahima, let's talk about the outlook as well.
Right. So, in the recent investor presentation, they did mention that, there's a robust summer demand which is coming in, and that calls in for a higher demand in the margin accretive products. And there have been good responses that they've received in these margin accretive models. They've also said that there is decent traction and thrust in semi-urban and rural markets, and of course in adjacent product categories, which will augur growth going ahead. And they're focusing on expanding product portfolio in Australia. And long-term strategy includes leveraging the Chinese subsidiary also for sourcing components and expanding geographically as well. So these are some points to definitely ponder upon, because they are expecting a strong summer demand, as well as planning to expand into more geographies. So these are the few guidances or outlook that the management has given with respect to the recent Q3 earnings call.
Okay, on that note, let's get in Nrupesh Shah. He's the Managing Director of Corporate Affairs at Symphony, who's joining us. Mr. Shah, good afternoon, and thank you so much for taking the time out. The question clearly will be, in this case, the outlook for the upcoming summer, because that's essentially what we wanted to understand. In the past, couple of years, the summer has been brought forward, which means that a lot of the sales already start taking place. A lot of the seasonal sales start taking place towards March and then onwards April and May. Can you give us an idea about what you are expecting as far as this particular summer season is concerned?
So as we pointed out earlier, season has begun very well. In fact, there is early summer, and not only there is a trade demand, but in some pockets of the country, there is a early consumer sales of air cooler, particularly South India and few other pockets of the country. And this is coupled with last year at the end of the summer, trade wasn't left with any inventory. So that is also helping overall. So in nutshell, we expect very robust growth and performance during the quarter.
Shah, Mahima also joining in, I just wanted to understand, with respect to all of your subsidiary, what's the outlook like? Because Mexico has shown a revenue growth of around 8% 9 months. China, of course, on a back of a lower base, growing at around 2 times. Brazil has also been resilient when it comes to growth, but Australia is the weak pocket for you. What's the outlook like for all of these subsidiaries, and especially for Australia, because you are, undergoing a transformation there?
So Australia is still bleeding, and the first phase of transformation in Australia we are done with. So cost of doing the business or its fixed overheads we have succeeded in reducing to less than half when we acquired. Its annual overheads were more than 15 million Australian dollar. Now it is less than 7 million Australian dollar. Second phase of transformation is almost done. That is converting completely integrated manufacturing facility into outsourced manufacturing, asset light, capital light, and on top of it, launching host of new products and direct selling to the consumers, establishing the dealer distribution network that is in very advanced stage. And we believe that once we are done with that, just like IMCO Mexico as well as GSK China, their initial years, initial phase was like this. It is exactly at that stage. And I believe that in a year or two, Australia should also turn around. Coming to our other good subsidiaries, that is IMCO Mexico as well as GSK China, they are doing very well and they are on a very strong growth and performance trajectory. And so is Brazil. Brazil is essentially a trading subsidiary. So essentially Brazil should be seen as exports from India, because there we do have a decent profit in India as well as margin at trading subsidiary level.
Okay. Mr. Shah, with respect to, a couple of things, you've mentioned that your long-term strategy does include leveraging the Chinese subsidiary for, sourcing components, and this is because you want to expand geographically as well. What are the plans where, geographical expansion is concerned? Which are the other areas that you're, planning to tap into?
We are not planning any further acquisition, whether in the country or internationally, because we believe that all important geographies and territories we are well covered. We can really serve very well from our existing companies. And in each of these geography, there is a huge potential to have organic growth.
Mr. Shah, the way I see your 9 months pan out, it certainly looks like you guys will register a good growth in FY25. I'm not asking you for a guidance, but I do want an indication of whether or not your growth rate for FY26 will be better as compared to what we have seen over the past, 2 to 3 years.
Again, it amounts to guidance, but all signs are summer is likely to be good, and so our June quarter performance may be good, and that drives the performance of the entire year. And in that case, in line with 24-25, we expect strong 25-26, not only Symphony India, but also our international subsidiaries.
And so I'm assuming that with the hope from investors' point of view that you do see a double-digit growth in FY26 as well. Do you think that margins could come in at around 18-19%? Because that's what we've seen in the first 9 months of the FY25. Do you expect to hold on to these margins, or do you think there will still be some challenges which will be taken care of over the next few quarters, and after that you start seeing a sustainable margin guidance of around 18-19%?
So whatever EBITDA margin percentage we have witnessed in first 9 months, we believe that we should maintain it. Maybe in the current quarter, we should improve upon that.
All right. Mr. Shah, one last question, with respect to the new models that you've introduced. In terms of these new models, they are margin accretive. Maybe you will maintain this, margin guidance in 9 months FY25. Going forward, FY26, 27, what's the scope of margin expansion? Because the new products that you've already mentioned are margin accretive, are comparatively newer, but will have a further effect going forward in FY26 as well as 27.
Depends upon the sales mix and product mix, but we believe that our current quarter, in terms of the EBITDA margin, should see the effect of EBITDA margin on new models, and down the line, that improved EBITDA margin percentage should be maintained.
Well, Mr. Shah, we'll leave it at that. Thank you so much for joining us here and talking to us here at NDTV Profit.
Pleasure.
So there you have it. So a lot more clarity, and certainly with a little bit more of a positive outlook coming in. Well, the management has already suggested that firstly, that summer has already picked up, and because of that, seasonal sales have also started contributing to the top line, and they are hoping that the FY26 will be a lot stronger in terms of your operational metrics. But on that note, we are completely out of time on this edition of KYC, but lost my lineup on the other side. Stay tuned in, and we'll be back in just a bit.